Welcome to the What's My Stock Worth training video. Uh, in this video, we'll talk about the do's and don'ts of investing. By way of introduction, my name is Ryan. I have a master's degree in accounting. I'm married with 3 kids. I'm a CPA and I spent most of my career in public accounting. My career is accounting, but my passion is investing. In the past several years, I've read everything I can find about investing and I've learned as much about it as possible. Over the years, I've made some good and bad investment decisions. I have over 10 years investing experience. You name it, I've done it. I've day traded stocks. I've purchased stocks short and long. I've shorted stocks. I've purchased puts, calls, ETFs, leveraged ETFs, mutual funds. I've sold puts and calls. I hope to help you save some money and make some money and avoid some of the pitfalls that I've made. And as part of this training, we will review the do's and don'ts of investing. So let's get started and jump into it. We will start with the don'ts. This is a simple rule, this first one, but unfortunately not everyone remembers it. Don't invest money you can't afford to lose. This is a simple rule, but just follow it. The next rule is don't buy stocks on margin. To give you a specific example, in 2007, I started investing again. I wanted to maximize my return, so I traded some on margin. So I had probably 25% of my investments on margin. Uh, but unfortunately, as we all know, in 2008, the financial crisis hit. And as a result, my stocks dropped significantly to the point where I had to sell some of them at prices I did not want to sell them at. Uh, it's This is just one of the reasons to not trade on margin. The other reason is it's the cost of the interest on the margin is just another hurdle you have to overcome in terms of performance. So I think the wise decision always is not to trade on margin. The next rule is don't buy derivatives. To give you a specific example, in 2007, I sold puts on ExxonMobil at a price that I thought there was no way it could drop in the next 2 weeks. Well, lo and behold, after hours, an announcement came from the company. So even though I had to stop, and because it happened after hours, the stock dropped. And when I woke up in the morning, I realized that I had lost $10,000. Now, for uh, an individual that's married with 3 kids and whose wife doesn't work, that's a lot of money. I think because of the innate nature of derivatives, that the leverage is built within it, it's just smart just to avoid them. Don't buy derivatives. The next rule is don't day trade. Uh, it may not seem much, but even though the trade prices have gone down, it's still very difficult to overcome this because the amount of money you make on each day trade in comparison to the cost per each trade, it's actually a large portion and it's a very difficult hurdle to overcome. And it's really going to make your broker rich. It's not going to make you rich. Uh, the next thing I would like to discuss is don't purchase all the shares at once. Now, how this works is to give you a specific example. Let's say you want to invest $6,000. So how you would do that? What I would do is I break it up into thirds. So I would buy $2,000 of the shares at currently. Then I would wait until the stock price drops 5%. When the stock price drops 5%, I would buy another $2,000 worth of shares. Um, so you end up with more shares at a lower price. Then you do it again. So the stock price drops another 5%, you buy another $2,000 worth of shares. This is called dollar averaging. Uh, Now, you ask, well, what happens if the stock goes straight up from there? Well, then you just don't buy anymore. But I would always dollar average in when you're purchasing your shares. The next don't is don't sell too soon. To give you a specific example, in April 2009, I purchased the Apple stock at under $100. Thought I was such a smart investor because 2 months later I realized that I'd made a lot of money, 20, 30%, and I said, I'm going to sell this. And I sold it for about $120 a share. Well, in 2011, Apple traded over $400 a share. Had I been smart and not sold too soon, I could have made 4 times the amount of money that I had originally invested. So again, don't sell too soon. It takes a while for the market to figure out what you see and what the true value of a company's stock is. For tax reasons and for other reasons, I would wait at least 1 year to sell your shares. So you ask, when do you sell? Well, selling is actually more of an art than a science. But some of the methods that you could use to determine when to sell after a year is if the stock drops below the 200-day moving average. Another option would be, this is probably the more solid one, is if you see the company has lost a competitive advantage. If that is the case, I would sell. The other reason would be is if the stock is trading at a significant premium. If you waited a year and you can see the stock is trading at a very large premium, I would sell them. The next rule I'd recommend is don't fight the trend. So in 2008, the stock started to drop, and I could see bargains all over the place. But even though as I purchased, the stocks kept going down, the market was so negative and there was so much dire opinions out there that it just kept dropping. There's no saying in Wall Street that says don't try to catch a falling knife, and I would agree with that. It's better to try to purchase stocks on the upswing than try to catch a falling knife. The next don't is don't invest in airlines. Airlines, for whatever reasons, over the long history, have never made money. It's because of the stiff competition and the high costs related to fuel. It's just best not to invest in airlines. The next don't is don't invest in banks. The reason for this is banks, the visibilities into banks is very cloudy. The reason being is, so let's say you have $5 in the bank. Well, the bank will go out, and on that $5, they may make $20 in loans. So innate in banks, there's a lot of hidden leverage. Also, there's a lot of accounting tricks that banks can do. There's off-balance sheet financing, so the banks can hide a lot of their liabilities. Also, loan losses. What the bank does is they set up a reserve for any loan losses they will have. These loan losses are very hard to predict, and it makes it very hard to get visibility in how the company is performing. It's because of the lack of visibility, it's just best not to invest in banks. And I think this next point is very similar. Don't purchase companies you don't understand. Just don't buy their stock. For example, if there's an insurance company and they're doing a lot of complex investments, an example would be ING, AIG. Just don't take the risk of investing in a company you don't understand. And I think a lot of that relates to banks because of all the hidden investments, off-balance sheet investing. It's very hard to understand it and to get visibility into how the companies were truly performing. We will jump into the do's. This is a very important do. Do your homework. You need to know more about your company you're investing in than your competition. I'll say it again. You need to know more about the company you're investing in than your competition. So how do you learn about the companies? You need to take the time to read the company financial statements, including the notes. They're free, they're online, they're available from the SEC. Listen to the company investor conference calls every quarter, every year that a company has an investor conference call. Get on there and listen to it and listen to what they are talking about. Another option would read consumer reports about the products the company sells. Read local newspapers. A lot of times, the local newspapers will pick up things that the national media doesn't catch about companies. And then the whole objective of this research is to get an understanding of what the company does and identify uh, competitive advantages. Uh, when you're doing your research, what you should be doing is answering the question why this company will outperform its competition. Like in many things in life, the simplest answer is the best in investing as well. It, it's very simple. You want to invest in good companies with competitive advantages that are selling at a discount. That's it. Very simple. So you want to invest in good companies which with a competitive advantage that are selling at a discount. I might say it a third time. That's it. Very simple. Invest in good companies with competitive advantages that are selling at a discount. Um, at the end of the day, that's what you want to do. When you make your investing complex, overthink it, get involved with complex instruments, it just clouds it. The best solution really is keeping it simple. Now I'm going to do a shameless plug. The What's My Stock Worth iPhone app is the best app out there. Uh, it is the best tool out there for establishing what the true value of the company is. It's priced at the less than the price of a stock trade. It provides the training you need to be successful. It also has built-in strategy that's easy to follow and easy to understand, and it's very effective. This is the only application I know out there that really gives you a view based on the parameters you provide into the true worth of your stock you're investing in. You to significantly improve your investment performance, and it will give you the tools you need by the investment calculator, the training, and the strategy to be successful. So just go out and buy it. Thank you.